Sequence of returns risk. Why market performance in early retirement years is critical. Welcome to another video in the FIRE and Early Retirement series. Today, we're diving into one of the most important, yet often overlooked risks that can determine whether your retirement plan succeeds or fails. Sequence of returns risk. Understanding this concept is absolutely crucial for anyone planning to retire early or even at traditional retirement age. So what exactly is sequence of returns risk? It's the risk that poor investment returns in the early years of retirement can deplete your portfolio faster than good returns later can recover it. Here's the key insight. The timing of returns matters more than average returns when you're withdrawing money. Early losses are significantly harder to recover from when you're taking withdrawals, because you're selling shares at depressed prices, and those shares are no longer available to participate in future market recoveries. Why does sequence of returns risk matter so much more in retirement than during your working years? During the accumulation phase, when you're building wealth, you're adding money regularly. Market downturns actually work in your favor because they let you buy more shares at lower prices. The sequence of returns doesn't matter much, but during the withdrawal phase in retirement, you're taking money out regularly. Market downturns now force you to sell more shares at lower prices to meet your income needs. This creates a devastating one-two punch. You're locking in losses by selling low, and you have fewer shares left to benefit from the eventual recovery. The sequence becomes absolutely critical. Let's look at a powerful example with two hypothetical retirees who have identical circumstances. Retiree A gets lucky with good returns early in retirement. Retiree B is unlucky and experiences poor returns early. Both start with $1 million. Both withdraw $40,000 per year, which is 4%. And here's the kicker. Both experience an average return of 7% per year over the same time period. The only difference is the order in which those returns occur. Same starting point, same withdrawals, same average returns, just different timing. After 20 years, the outcomes are shockingly different. Retiree A, who had good returns early, still has over $1.5 million. Their portfolio actually grew despite taking out $40,000 every year. Meanwhile, retiree B, who experienced poor returns early, has $0. Their portfolio was completely depleted years earlier, and they ran out of money. Same average returns, same withdrawals, completely different results. This dramatic example illustrates why sequence of returns risk is so critical to understand and plan for. The first 5 to 10 years of retirement represent the most vulnerable period for your portfolio. Why is this window so critical? First, your portfolio is at its largest size right at retirement, so market losses are magnified in absolute dollar terms. A 20% loss on $1 million is $200,000 gone. Second, you're selling shares during downturns to fund your living expenses, which locks in those losses permanently. Those shares can never recover because they're no longer in your portfolio. And third, recovering from early losses requires even higher returns when your portfolio is now smaller, making it mathematically harder to get back to where you started. Fortunately, there are proven strategies to mitigate sequence of returns risk. First, maintain a cash buffer. Keep 2 to 3 years of living expenses in cash or short-term bonds so you can avoid selling stocks during market downturns. Second, consider a bond tent strategy. Increase your bond allocation before and early in retirement to reduce volatility, then gradually reduce it over time as sequence risk diminishes. Third, use flexible withdrawals. Be willing to reduce your spending during market downturns to preserve your portfolio's longevity. And fourth, consider delaying retirement if you're facing poor market conditions, or work part-time initially to reduce withdrawal pressure on your portfolio. Let's recap the key takeaways. Market timing in your early retirement years has an outsized impact on whether your portfolio lasts throughout retirement. Average returns don't tell the whole story. When you're withdrawing money, the sequence in which those returns occur matters tremendously. And finally, cash buffers, flexible spending, and strategic asset allocation can protect you from sequence of returns risk. The bottom line is this: plan your retirement strategy with sequence risk in mind. It could literally make the difference between a successful retirement and running out of money. Thanks for watching, and stay tuned for more videos in the FIRE and Early Retirement series.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.